bring Sam back into the conversation here. And we'll also bring in our next guest joining us now, Ahmed Khan, the equity analyst for technology at Morningstar, to take a look at Meta and Alphabet, some of the performance that we're seeing in the markets today on the heels of those reports yesterday. Ahmed, if you don't mind, it was a tale of two very different stocks today. Let's start with Meta. I was just looking at them on the board, still down more than 11%.
First of all, thank you so much for having me on here. So as you correctly pointed out, I think it was two very different reactions from the street to two pretty incredible quarters, both in terms of how strong the quarters were, but also what the forward-looking guidance implied. Our read on Meta, we maintained our $850 fair value estimate. Our read on Meta is that the company's top line will continue to remain strong, and it's being driven by these AI improvements the company is making. We don't think that that's being priced in right now. We think investors are getting concerned about the 2026 commentary, what that means for OPEX and CAPEX, and what that would do to margins at Meta. But we think that over the long term, Meta's investments in AI the company will be able to generate a decent return on them.
But how come the street, Ahmed, isn't able to see that right now? I mean, you mentioned that there seems to be some sort of margin concern, particularly at Meta, because, as far as spending discipline, it does look like the view out there is that Google, Amazon and Microsoft are perhaps doing a little bit of a better job on that front. But, what is it going to take to see a little bit more conviction here? Because, I mean, Marley and I were talking about this reaction from the analyst community today. And, I mean, you've had several analysts now lowering the price target and, some downgrades there as well.
So first of all, I think it's important to understand that Amazon, Microsoft, and Alphabet have an advantage that Meta does not, and that is their public cloud businesses. So they get to de-risk their AI investments by basically telling the street that, hey, we've got external customers who can sort of purchase this capacity. At the same time, if you take a company like Alphabet, they are a huge internal customer for itself. So they have search and YouTube and a bunch of other products such as Waymo and all their Google ventures, and they are very compute intensive. So, the ROI in terms of, what utilization you will have on these AI servers, it's easy to understand why that would be high for a long period of time. Now, for Meta, you don't have the public cloud business, so you essentially need to make an ROI argument based on what improvements you can make to your top line, or what new areas what new revenue streams this technology will be able to unlock for you. And I think that's where the primary disconnect is. When we're looking at this quarter and we're looking at the last few quarters, what we've consistently seen is, first of all, that the revenue growth number that they put out yesterday, around 26%, that was the highest growth the company has seen, barring one quarter, I think it was 2024 Q1, in the last 15 quarters. So, I mean, that at scale is quite impressive. But if you look at the contours of the growth, you'll notice that a lot of it was driven by these AI investments, not just in GPUs, but more broadly, the investments the company has been making in their AI infrastructure. And these advantages, such as better ad targeting, better content recommendation, they compound over time. So in terms of what the catalyst would be for investors to change their mind on the stock, I think it's going to be similar to what we've seen with some of these hyperscalers as well. Google was seen as an AI laggard. We didn't view it as such, but the turnaround really began when investors started seeing actually strong adoption of Google Cloud and Gemini and what have you. And the print last night actually sort of proved that. So I think Meta will need more proof points of the return that I think investors are perhaps struggling with right now.
And Ahmed, before we pivot to talk about Google's results, I do want to ask one final question about Meta. They have a history of aggressive spending. This is something that we've seen from them, Reality Labs to their AI infrastructure. But one of the analyst notes and also a guest that I had on my earlier program mentioned a similarity to the metaverse, and I wanted to get your thoughts on that.
Well, first of all, we don't think it's similar to the metaverse. Metaverse, in our mind, and you can sort of go back and sort of read our research from back then, we thought it was not a great idea. This time around, what is happening is that we think this is an actual paradigm shift, to the scale that we've seen before, whether that's the internet, etc. So if you agree that this is a paradigm shift, then the next question is, does Meta again want to be beholden to another tech company for their infrastructure or their distribution? And by the way, like, one thing I would sort of push back on is this idea that Meta could have like avoided severe margin compression while investing in AI or using AI. So if you're a company of 3.5 billion daily users, you cannot actually use any of these generative AI models, even if you partnered up with a Google or an Anthropic or an OpenAI, without incurring massive operating expenses, because these models are expensive. It's the same reason why Meta actually owns its own infrastructure. It doesn't use a hyperscaler like AWS or Azure or GCP. It has its own data centers, because investors and Meta's sort of like, leadership team understands that this is the best cost structure. So again, with Gen AI, if you agree that it's a paradigm shift, and if you agree that like them using someone else's models would be incredibly expensive in the long run, I think the correct response to all these sort of like in these dynamics is to invest in your own AI. I think what's not helped the firm is that their efforts have been subpar so far. At least Llama 3 was actually pretty impressive. Llama 4 was not so much, and then the company went on this hiring spree. And I think that's where the story got muddled, and the company will have to improve its execution on AI to regain investor confidence.
Okay, and just very quickly, Ahmed, before we let you go, obviously we have to talk about Google Alphabet as well. I mean, that was a healthy report that we saw there. The street is rewarding the stock today. We've also seen it earning itself quite a list of price target boosts here. I see that you've raised the fair value estimate by a wide moat to $340. What were you most encouraged by, and can they keep it up?
In terms of what we were most encouraged by, I guess that that question gets at what surprised us the most, or what positively surprised us the most. Number one was search resilience. Search growing 15%, again, one of the strongest. I think it was the strongest growth the company has seen in search since the launch of ChatGPT, which by itself is quite impressive. Then on top of that, just the backlog number for Google Cloud growing, some like 40-some% sequentially, 79% year on year, just implies incredible growth coming online in 2026. And one final thing I will say is that this was not part of earnings, but yesterday, Amin Vahdat, who is the head of infrastructure at Google, he was on a podcast and he said that they were using 7-8-year-old TPUs at 100% utilization rate, which really de-risks your investments. If you can think of these TPUs and these AI servers that you're buying right now and you're putting up all this capital for, if you can use it for an extended period of time, because the incremental sort of like value after you've depreciated the asset over 6 years is actually the incremental margins go up quite significantly. So I think all those things put together gave us a conviction. But I would just like to say that even before this quarter, we were optimistic on Alphabet, and we were even when the stock was trading in the 140s, 150s back in April and May, we thought the company was an AI leader, not a laggard, and the market has come around to sort of agreeing with our thesis on Alphabet.
Well, Ahmed, we appreciate you taking the time to be with us to break down those earnings. That's Ahmed Khan from Morningstar.